Good morning, everyone, and welcome back to the Peterson Institute for International Economics. I'm Adam Posen, the Institute's president, and it's my pleasure to be here again with my close colleague Karen Dynan to present the semi-annual Global Economic Prospects we do at the Peterson Institute. Karen has been leading and coordinating this effort for the last few years, following on Mike Musa and David Wilcox, who previously were in that role, and she's been doing it in increasingly challenging times. Before Karen makes her remarks on the global outlook and an in-depth dive into the US recovery, including looks at labor markets and the effect of fiscal policy, I wanted to say a couple words about our forecasting exercise. As many of you who tune in regularly know, we're not an investment bank, we're not the OECD or the IMF, we don't have a huge staff that comes up with point estimates for growth for every country. But what we try to do is go to places where in the G20 and the major economies, where the official sector for political or institutional reasons cannot make the calls, or where various other people have blinders. And we try to point out where we differ from the consensus. Looking back a year ago at Karen's forecast at the start of the pandemic, she and the team got a lot right. They called a more rapid and stronger recovery. We came out with the idea of a reverse checkmark recovery, which I think conveyed a lot more information and proved to track things much better than the V or the W or whatever letters were chosen. Our colleagues like Nick Lardy and Tianlei Huang on China rightly forecast a much higher bottom and recovery in China. Our colleague Monica DeBola rightly, sadly, forecast underperformance by Brazil and Mexico. And we had a positive view overall on the economic response to, of course, a horrible human tragedy of the pandemic. And we obviously got some things wrong. And in particular, we, like many others, did not foresee at all the differences in performance of public healthcare systems around the world, that the US and the UK and Western Europe would fail so badly, that Taiwan and South Korea, Australia, Israel, New Zealand would fare so well, that to everyone's great surprise and pleasantly, India and a number of other developing countries had far fewer deaths, though still horrifying, than was feared. And then, of course, the sad fact that in the US we've had far greater deaths than probably should have happened. Just to say that next week we will be launching our new report to the G20. It's not commissioned by the G20, it's a PIE briefing led by Monica DeBola, Maury Oatsfeld, and myself on economic policies for a pandemic age, and I hope you'll join us then. But now let me turn to Karen Dynan. Karen is professor of the practice of economics at Harvard University, teaching in both the economics department and the Kennedy School. Karen served as the Assistant Secretary of the Treasury for Economic Policy and therefore also the Chief Economist and Chief Forecaster for the Treasury during President Obama's second term. She has a long and distinguished career in economic policy research, starting at the Federal Reserve, becoming one of the world's leading experts on savings behavior and the policy implications thereof, and also at time being Vice President and Director of Economic Studies at our friends across the street at the Brookings Institution. Karen, please take us through your forecast.
Thank you, Adam. It's a pleasure to be here. I'm going to start by sharing some slides. There we go. Just give me a minute. Get things running. Yeah, so it's a pleasure to be here and to be doing another update of the global economic outlook. The global economy is still facing many challenges and uncertainty, but the economic recovery continues. And in fact, the outlook looks brighter than it did 6 months ago. The chart I'm showing you is the level of real global GDP normalized to 100 in 2019. And as you can see, the global economy is on track to grow more than 5.5% this year and almost another 4.5% next year. We're forecasting a stronger global recovery relative to our thinking last October because progress with vaccine development and supply has been faster than expected, and because fiscal support, particularly in the United States, has been larger than expected. The strength and timing of the recovery will differ across countries, and that's partly because of different experiences with the virus and vaccines. On the left, I'm showing you new confirmed cases with the virus. You have to take these numbers with a grain of salt because some countries are doing less testing than others, but the chart makes the point that the virus is much more prevalent in some places like Brazil and some parts of Europe than it is in other places like China and Australia. And on the right, you can see the big disparities in vaccines among major economies, with the UK and US way ahead of some other countries, particularly those in the emerging world. Economic prospects also differ across countries because of different policy responses, particularly fiscal policy. There is a huge range in the amount of government funds going out the door, through additional spending, although also some through lower taxes. And in the United States, discretionary fiscal support since the pandemic began is more than 20% of GDP. I'll have more on that in a minute. In other advanced economies, fiscal stimulus has been smaller, and in lower income countries, stimulus has been smaller still. There are also big differences in the timing, structure, targeting of the responses, and that's all going to be relevant to how they're influencing the economic recovery. So this slide shows you an overview of my forecast for the large advanced economies. So again, as with the first chart, I'm showing you the level of real GDP with every country, benchmarked to 100 in 2019, so that you have a sense of how they compare with each other, but also when it is that they pass their pre-pandemic highs and how far they'll climb in 2022. So the United States is way out ahead of other countries because of the aggressive fiscal response and somewhat relatedly, the amount of excess saving that has accumulated here, as well as the fact that we are doing so much with vaccines. The Euro area lags the United States in part because of virus outbreaks and new lockdowns, but we expect the recovery there to be in full swing later this year when they catch up on the vaccines. Japan is seeing a slower recovery, held back in part by limited progress with vaccines, but also by the decision to ban overseas tourists from the Olympics. And the UK, of course, has had its virus struggles last year. Oops, accidentally. It's doing better this year, but as we've been saying for a while, we think the Brexit transition is a bigger deal than a lot of people appreciate, and it will drag on the recovery. So let me move on to the large emerging economies. It's no surprise that China really stands out given their success containing the virus. Global weakness last year weighed on China, but it is posed to grow very strongly this year. India has been bouncing back from a very bad 2020, although there is risk to that forecast because of the virus. We think Russia is on track to grow this year, although it is not using the fiscal space it has, so that could be an issue for the Russian recovery. And we continue to be very worried about Brazil. It had structural problems going into the pandemic, and the virus situation is just terrible right now. So it is the only major economy where we're forecasting a decline in GDP this year, and we think the virus strains are so bad that the healthcare system is in fact teetering on collapse, and that will weigh heavily on the recovery. So let me do a deeper dive now on the United States. I have to start by getting the elephant out of the room. Fiscal support in the United States has been enormous, with a big package last spring and almost another $3 trillion in the last couple of months. So my forecast is assuming that far from all of the money will be spent immediately. I do think there is a pretty good case for that assumption. We have survey data where households have said they would like to be saving the money and paying down debt. We don't think that people will be making up all of the services consumption they missed last year. You're not going to get twice as many haircuts this year because you missed haircuts last year. But also we think that there was a bunch of spending on durables last year that was pulled forward. Moreover, and this point is really important, the funds have been distributed very broadly. So, for example, states are getting a lot of money and they can spread that spending out over several years. And even among households, it has not, the funds have not been that well targeted to people with high spending propensities. So with that out of the way, let me show you some very current indicators that are consistent with the idea that a big swing in the US economy is underway. So the very timely New York Fed Weekly Economic Index that I am showing you on the left in this chart has recently popped up. We also have daily data on consumer confidence that has come way up in the last couple of months, even if there has been a bit of a flattening over the last few days. And we think the recovery is going to be very consumer driven, and that some of the sharpest growth is going to be seen in the high contact services categories that to date have been very held back, both by formal restrictions, but also importantly by people's choices, because they have just feared contracting the virus. So as you can see in this chart, which is showing you consumption in February 2021, our latest reading, relative to January 2020. And the bars are grouped by durables, non-durables, and services. But if you look at the bottom of the chart, you can see that services related to travel, dining out, indoor entertainment were all running very low relative to their pre-pandemic values as of February, as they had been over the prior year. But we think as more and more people are vaccinated, spending in these categories should go way up. And people in the United States have plenty of financial resources to power this spending. On the left, I'm showing you the levels of consumption and income, and the shaded area in between is saving. And if you look at consumption, you can see what we all know, which is that it has been very constrained by the pandemic over the past year. Looking at income, we've seen bursts of income related to the fiscal measures. So if you look at the difference between these two series, you can see why it is that people are talking about all of this excess saving that is out there. At the end of 2020, it looked like saving was about $1.5 trillion or 7% of GDP above normal. And then of course, early 2021, with new fiscal funds streaming in, have just seen kind of more accumulation, bringing excess saving up probably to $2 trillion or more. And of course, active saving has been supplemented by the big increases in asset prices that we've seen, both through the stock market, but also through housing, such that household wealth rose very strongly in 2020. In the business sector, we have a lot of measures telling us that businesses are very confident about what's to come. This chart just shows two of my favorites. Durable goods orders have been running well above pre-pandemic trends. And then on the right, even though we've seen many business failures, particularly in the small business sector, applications to open new businesses, and this is showing you new businesses that are likely to create jobs, that has been running very high for a number of months now. So with that set up, this brings me all to my actual forecast, which you can see in this chart. As you can see on the left, the pace of recovery, it slackened at the end of 2020 after this sharp rebound over the summer. But we expect the pace of recovery to pick way up, with the first half of this year averaging about 7.5% in terms of GDP growth at an annual rate, with an increase that's almost as large in the second half of the year before kind of growth moderates as we go into 2022 and eventually gets back to, not over this forecast period, but in 2023, we'll get back to its longer term trend of just under 2%. That's the growth forecast. We should still, notwithstanding all this growth, we should still expect it to be a while before the labor market normalizes. Notwithstanding strong payroll growth, we are roughly 12 million jobs below normal now. And I think when you're thinking about how fast the labor market recovery is going to occur, I want to caution you from tying job growth to GDP growth too tightly right now, because simple rules like Okun's law, they key off historically typical patterns of the relationship between GDP growth and unemployment. So in other words, they're keying off historically typical patterns of productivity. But it's really hard to say what productivity is going to look like going forward. And I think there's some important cross currents. So on the one hand, we know that the services sector is likely to show the strongest growth this year, and that particularly the parts of the services sector that have been effective have lower productivity growth than the economy as a whole. Okay, so that's going to weigh on productivity growth. But on the other hand, we've got kind of exit of weaker businesses and some substitution of capital for labor. I'll talk about that more in a minute. That is going to boost productivity. So all told, I think we'll see monthly job growth of about 700,000 for the rest of this year. We're going to get an employment report tomorrow, so that'll be our first piece of information on that score. And then job growth drifting down to 300,000 per month next year, with the unemployment rate falling to 5% at the end of this year and drifting down to a little under 4.5% at the end of next year. And the really important thing to remember about the path of unemployment is that the recovery to date greatly overstates the improvement in labor market conditions, because we have all of these people who have dropped out of the workforce because their prospects for jobs have been so depressed by the pandemic. So labor force participation basically has been stalled since the middle of last year. But I do expect that the labor force participation will start to pick up slowly at first based on what we usually see in a cycle, but then accelerate. Although I don't think it will be back to pre-pandemic levels by the end of 2022. So under these conditions, I think the most likely outcome is that inflation will rise somewhat on a sustained basis. And the graph in this chart shows you my forecast. We are going to see a little burst of measured inflation in coming months because of what's called base effects related to the fact that the lockdown a year ago resulted in a couple of months of very weak prices. But you want to cut through that. Okay, the important trend is that inflation, I think, will slowly pick up as demand expands at such a fast clip. So by the end of 2022, I am projecting core PCE inflation to reach 2.2%, which would be the highest we've seen since before the Great Recession. But I don't see inflation being on track in 2022 or beyond to spiral upward like we saw in the 1970s. And that's partly because inflation expectations have been so anchored. I have household survey-based data on the left in this chart and implied inflation from the tips market on the right. And there's just not a lot to get excited about it. And I should say these patterns of kind of a lack of a sharp pickup in inflation expectations, it's not just these two measures. You can look at a whole variety of measures that people are watching, and inflation expectations just don't seem to be picking up much. Okay, so under these conditions of inflation staying below 2.25% and inflation expectations being generally anchored, and the unemployment rate still, or labor market still not having fully normalized, I don't see the Fed raising the policy rate, certainly this year. And I think the most likely outcome is they will not do so next year. Fed leaders have consistently stated that they would welcome a pickup of inflation to this rate, at least for a time, under the new framework, and so that we can make up for past shortfalls in inflation. Now, I should say, Adam is going to speak in a minute, and he will build more on inflation and Fed issues. So stay tuned for that. But the last thing I want to say about inflation is that, of course, there is an active debate about the risk that the US economy will overheat and what that implies for inflationary pressures. And here I will say that the strength of inflationary pressures over the next few years is especially uncertain and difficult to predict, given that there is no historical analog to the combination of forces the economy is facing now. Okay. However, it is certainly possible that inflation could pick up on a sustained basis by more, materially more than I have in my baseline forecast. And I think there's a non-trivial chance that this could happen. So if it does, the Fed is likely to raise the funds rate sooner than it currently anticipates. I think, everybody hopes for that to lead to a soft landing, but you can't rule out a kind of a harder landing whereby longer term interest rates rise, asset price drops, and the economy falls back into recession. That's not to imply that the Fed's current wait and see approach is not optimal. If you think of them operating under a kind of scenario planning framework rather than just a single baseline forecast, I think there's a real case that what they are doing now with wait and see is optimal. Okay, so with that, I want to spend my last few slides talking about what the future holds for households. There has been much talk about a K-shaped recovery, and I think there are some good reasons to be concerned that the recovery, not just this year, but over the longer run, is going to be uneven. So for some households, continued employment during the recession and or government stimulus payments has led to an accumulation of saving, like we are seeing in the aggregate, and that those savings are going to enable them to move strongly when the pandemic is behind us. In fact, some households are going to emerge from this episode stronger financially than they were prior to the pandemic. But we have to worry about other households where sustained unemployment, things like childcare burdens, poor schooling, and other factors could really hinder their post-pandemic prospects. So let me just walk you through just a couple of slides on this. So just looking backward, we know that lower wage workers have borne the brunt of job losses. And this chart shows you employment rates for high wage workers, as well as employment rate for low wage workers. And it basically shows you that employment rates for higher wage workers basically had completely recovered by last fall. Okay, so those workers as a group were no longer in recession really, or in a jobs recession. But that employment rates for lower wage workers have not recovered. And in fact, they slipped at the end of last year when the recovery was stalling for the economy as a whole. So that's not surprising, given that we know that parts of the service sector have been hit very hard and that those parts employ lots of low wage workers. Okay, and we do think job prospects for lower wage workers are improving. So I just told you kind of my view earlier that we think the pickup in demand is going to be for high contact services. But here's another data point. The chart on the left here shows you that job postings for workers with minimal education shot up earlier this year. Okay, but it's really a question of how much and how fast conditions will improve for these workers. So one reason for pessimism is that we have lots of jobs that need to be created, and the disruptions endured by many businesses, especially some of those in the services sector, are going to be hard to overcome, which is going to slow the hiring of lower wage workers in the coming months. Moreover, some of those jobs will never be recreated because of automation and other sources of efficiency gains. So these are some results from a survey that's done by the Fed and Duke University. And you can see on the left that more than half of large firms responded last year that they were implementing or planning to implement automation to reduce their reliance on labor. Results from the same survey indicated that most firms expected the automation to affect their lower wage workers. We may also see some scarring of labor force participation among people who have had additional childcare burdens because schools and daycare centers have been shut for some or all of this period. This chart shows you female labor force participation by group, and you can see that the participation rate for the age group most likely to have young children, women between 24 and 35, has shown little recovery from its decline in the early part of the pandemic. This contrasts with the pattern for other age groups, which you can see in green. It also contrasts with the patterns for men, which I'm not showing you, but you can look at. And of course, these rates may recover as schools reopen, but one worries that family responsibilities have, in this time off from work, have led to earnings and career setbacks that may be difficult to recoup and keep some of these women out of the labor force for the longer term. We've also seen a striking pattern for older workers. As you can see in this chart, the labor force participation rate of workers age 55 and older moved in line with that for younger workers earlier in the pandemic, but has since continued to trend down in a way that we haven't seen for younger workers. And I should say, looking at the coverage of this trend, most of it has been negative on the view that it's difficult for older workers to find new jobs, so they are being forced into retirement. And I agree, that is happening for some people, but I'm not sure it's all a bad news story. In contrast to the experience in the last recession, the wealth of households in the age group in which most retirements occur has increased sharply. Look at this chart on the left here. It's just a real contrast relative to what we saw, say, during the Great Recession. So while some older households may be forced into retirement, some may be choosing it because gains in their 401k balances, as well as other saving in 2020, are enabling them to retire sooner with adequate resources. And I will close by saying that the channels I've laid out here may not be the only way that the K-shaped recovery is playing out. Okay, so first of all, it may not be just a job story when you're talking about labor markets. It may be a wages story. In the last cycle, wages were depressed for a long time at the lower end, and although they eventually picked up in the second half of the last decade, they did not recover much of the ground they lost relative to higher end wages. Okay, they started growing like higher end wages were growing, but they didn't recover that gap. We also know that millions of households have fallen behind on their rent. Some estimates are as high as 10 to 15 million households owe thousands of dollars in back rent. The good news there would be that there is money in the recent fiscal packages to help these households. But it's gone out to states, and we don't know how quickly and effectively states will kind of use that money. And of course, we know that there have been disparities in remote learning by income, and it's hard to say how much of those gaps can be made up versus representing permanent setback for the children in those families. So that's my last slide. I will stop sharing, and I'm going to turn things over to Adam. But thank you for listening.
Thank you very much, Karen. And just as a reminder to our audience, those of you who are registered guests can pose questions using the Q&A function on Zoom. We will get to those in approximately 10 minutes. Also, a reminder that not only is this all on the record, but Karen's slides and related materials and my slides are going to be posted on the Peterson Institute website, along with recording of this event. We look forward to you sharing it widely and reacting to what we have. As Karen mentioned, I'm going to do a idiosyncratic and deeper dive on the issue of monetary policy and inflation risks. So let me now share my screen. Okay, so I'm going to argue that the US has had a monetary regime change and then try to answer the question of what difference does that make to overheating, which is of course the topic of the day. Will the Fed face overheating and how will they react? I think the critical point in the overheating debate is not that we're going to have a huge overflow of fiscal policy versus what the output gap is. I think Olivier Blanchard, Larry Summers, and others have made a solid case for that. The question is whether the Fed will need to cause a recession in 2023, 2024 in order to cope with any inflation pressures that arise. Essentially, does overheating have a cost? If we don't have sustained inflation and there's no need for the Fed to tighten, no harm, no foul. We raise the inflation rate, we have an extended recovery, all is good. So one has to acknowledge this is the first truly credible inflation threat in decades. And this threat is coming at the same time the Fed has announced a new strategic framework. So if you want to address this question, I think we have to look at a few sub-questions. What's the nature of the Fed's regime shift? How much inflation will appear when? How will the FOMC react to that inflation? And then what happens to the economy when the FOMC does react? So let me try to take you through my views on that. First, what is the nature of the Fed's regime shift? I want to give credit to Chair Powell, Vice Chair Clarida, and everyone in the FOMC. There's been a really thoughtful, deliberate process running from Chair Powell's speech at Jackson Hole in 2018 through the Fed Listens conference in the summer of 2019, through the announcement of the strategy to change the strategic framework at the end of August last year. I think they learned from mistakes and longstanding critiques, including some I and some co-authors made. And I think they're in part inspired by Greenspan's great achievement of the mid-1990s, which was to not fixate on a pre-existing estimate of the NAIRU and hold off on raising rates when that pre-existing unmeasurable NAIRU estimate was breached. I shouldn't say unmeasurable, unobservable. I think there are three key elements to the strategic shift. Don't rely upon, let alone trust, estimates of unobservable R-star and U-star. Focus instead on broader markets of labor market slack, notably labor force participation, as opposed to, say, U3, narrow unemployment. This was a point Danny Blanchflower and I pushed in 2014, unsuccessfully to forestall the rate hike then, but seems to have been borne out. To make a reassessment of the relative risks, both in terms of costs and likelihood of overshooting on inflation versus undershooting on unemployment. And if you take those three stated changes together, what you end up with is a policy recommendation, a strategy that you wait until you see actual macroeconomic outcomes, notably inflation outcomes, before you respond to policy. This is a major shift from what we could call canonical inflation targeting from the mid-90s until just now. That was very committed to a Taylor rule approach of focusing on R-star, focusing on inflation, and being preemptive in your responses. So does this regime shift matter to the inflation outlook, the actual outcomes? So there are arguably two schools of thought about inflation and monetary policy. The dominant school for the last 3+ decades has been that the central bank's counterinflationary credibility in and of itself is the primary determinant of medium-term inflation outcomes. So if you anchor expectations, that alone means low inflation. An opposite view, which has been out of fashion, but which I think has reemerged in response to the evidence accumulated over the last couple decades, is that economic fundamentals, how much wage bargaining power is there in the economy, how credible is fiscal policy, are primary determinants as well from medium-term inflation outcomes. So expectations don't jump based solely on monetary policy, they track these developments, probably with a lag. Now, if you're doing realistic policy, you have to allow for both, but you have to make a call about how fragile are inflation expectations to policy expectations, and then in turn, how fragile are inflation outcomes to actual expectations. And I've been quoted several times as saying this is a religious question, because the argument essentially comes down to what you think is relevant. If you believe the 1970s are relevant, then what you do is you include the 1970s data in various of your estimates, and you end up with results that can be interpreted as saying you have inflationary spirals if you don't have credible monetary policy. If you say, well, no, the 70s are not entirely relevant to today, and you cut those data points out of your estimate, then you end up with very different implications. Now, most central bankers hedge their bets, and they say, well, the reason things are different now than the 70s is because we have a better Fed regime, because we have a better monetary regime. So, what the Fed is saying is they're acting as though this shift in regime will not dislodge inflation expectations. Now, I think this is right. In the sense of it's an accurate forecast. And I said when they announced this, I said at the Fed Listens conference, don't expect to raise inflation just because you change your regime. And I'll say now, don't expect to overshoot inflation because you change your regime. It's actions, not guidance, that matter. Now, given all that, I do, perhaps seemingly intentional with that, I want to suggest that the inflation forecast is too modest. I sort of spliced together two charts from Karen's presentation here. They're really not apples to apples because on the left is 5-year ahead market forecasts. On the right is Karen's forecast of the actual headline PCE. And I tried to just get the 2% lined up. But the basic point is at reasonable horizons, if you look at the Fed dots, if you look at markets, if you look at my colleague Karen's forecast, people are projecting a very low rise in inflation over the course of the next couple of years. Now, I don't think this is quite right. I think being calm from a normative point of view that inflation is not a big deal is fine. But as a forecasting matter, I think people are too sanguine. The next couple of years, this year, next year, inflation outlook to me has a lot of upside risks, and I list them in decreasing likelihood. Obviously there's base effects coming in, as Karen mentioned, and what she calls speed effects. I think one thing that repeatedly gets overlooked is that there is pent-up demand for healthcare in the US system. Unlike other services, unlike haircuts or restaurants, people who put off plastic surgery, people who put off cancer treatment, people who put off anything in the elective range between those two, though they have demand they want to fulfill. And we're already seeing this if you talk to the health insurance companies. And so I think people are underestimating the extent to which we're going to have healthcare inflation over the next year and a half. Additionally, to the degree we get Obamacare re-extended into Biden care, which again is a good thing, that will also probably release some pent-up demand for healthcare for people who had lost access to health insurance for a few years. So I think the prospects for meaningful healthcare inflation are underestimated. I think also some people tend to underestimate the potential for bottlenecks showing up in energy and in trade, and I would have said this even before the Suez Canal incident. As Karen mentioned, there's uncertainty about the multiplier in fiscal stimulus. It is possible, if you look at the facts Karen mentioned about paying down rent, that people are in harder straits than the top-down numbers might say. And so even depending how you allocate rent payments, you might still be paying more out as a result of the fiscal stimulus. I think also, and this is not a high probability event, but I think it needs to be taken seriously, there's the possible of the potential jump in monetary velocity and investors' animal spirits. I think this is one of the good aspects of the American Jobs Program infrastructure bill the president mentioned yesterday, that there's some chance genuinely sustained large-scale public investment, as a number of us have been saying, including Larry Summers for a long time, will raise R-star. I'm not going to pretend I know what R-star is, but I know that it is a marker of how low expectations are for growth and how little risk demand there is. And I do think that a sustained infrastructure push could help push that up. Now, some of these are desirable effects, but to me, it's like Sam Spade at the end of The Maltese Falcon when he's talking to Bridget O'Shaughnessy. Yeah, there's all these reasons why I can't trust you. It may be that some of them are not very important, but look how many of them there are. So to me, the inflation forecast should be something above 3% for the next 18 months rather than 2.3. So if we get my outcome or anything close to it, how will the FOMC react to that? When will they react to that? So the Fed strategy right now, and again, I agree with Karen, is rightly to say we're going to wait to raise rates until labor force participation is close to pre-pandemic levels, or wages have risen for a while, or inflation expectations get unanchored. Now, the first two, if you're optimistic, you'd start to see signs of that by about mid-2022, but there's no harm in waiting to see how that plays out. So if Karen's right, wait till the end of 2022 easily. Inflation expectations, though, are likely to be quite volatile and around an upward trend. And so the FOMC majority is going to try to look through one-time shocks to inflation, and they'll keep saying it. So likewise, I mentioned with healthcare, even if that turns out to be a very large component of core PCE, the fact is they can say, well, there's only a finite amount of pent-up healthcare demand. This is not going to be ongoing. We can wait. So the question is, can they sustain that stance? One issue is going to be, as Karen stressed, observed productivity outcomes. If you're trying to follow Greenspan in the 90s, what you want to do is see a positive surprise on productivity, because of course that's counterinflationary, gives you more space to run. As Karen mentioned, and as other colleagues at the Institute have been working on, we care very much, both from a normative but also from a policy point of view, about how much formal labor force participation you get for prime age women. And it's not clear what the level of scarring is. The more scarring there is, the less women come back to full or dedicated part-time work, the more inflation you're likely to get because of constraints on labor supply. But then the real problem is going to be people are going to insist on making a big deal out of financial market expectations of inflation. And these should be ignored, but they won't be. So given that, that's why I don't think the Fed's going to be able to sustain its restraint beyond the end of 2022, even though I hope I'm wrong. All right, so if they don't want to raise rates, what can they do to manage expectations short of raising rates? I think there's a lot of hubbub right now about the Fed needing to actively deal with the current steepening of the yield curve a bit and the rise in 10-year rates. I think this is silly. Chair Powell's right to say just chill, relax. But to twist an old saying, markets can be silly for longer than central bankers have hair to pull out in frustration. Think of Bernanke with the taper tantrum. So if you need to try to convince the markets not to keep pushing up the interest rate for no good reason beyond where they have now, then you need to think about other things. And so I think one of the most important things, which I believe the US Treasury and Undersecretary Lang is looking at, is improving the plumbing for the treasuries market so we don't have a repeat of a year ago. I think you have to talk about macroprudential tightening on non-bank financial institutions. And if we start seeing bubbles in residential real estate, you have to figure out ways to manage that so you don't get people calling for rate hikes for that reason. I think you have to downplay the importance of market expectations of inflation and play up the importance of productivity and labor force participation. I mean, clearly the Fed is doing the latter, but they're not yet doing the former. And fourth, I think you should be, both for communications purposes, but also substantively, keeping the policy option of yield curve control on the table. It's working quite well for Australia and for Japan. And I think they're right. There was an extensive discussion 9 months ago, I think, at the FOMC about this. And they said not right for us now, but not ruled out. And I think keeping that alive will help. What I don't think is going to happen, which is what the markets seem to be focused on, is the idea that they're going to tinker with the asset purchases or the balance sheet long before they hike rates. Now, there's occasionally an operational reason you might mess with the balance sheet and the asset purchase program right before moving rates. This is about whether you try to do something independently on that. And if I was advising the FOMC, I'd tell them not to waste their time. It serves no purpose. You get all the political pain and some of the financial stability pain if you do this, meaning cut back on asset purchases, try to curtail that, while at the same time you don't have any confidence that you're going to have the desired effect on inflation expectations. You may just create a further drumbeat to raise rates sooner. So to me, this is a pointless policy. And frankly, I think they're not going to use it. All right, so what happens to the economy when the FOMC does react? To me, the critical point in the debate that our colleague Marcus Samuelson held between Paul Krugman and Larry Summers a month and a half ago was the dispute over whether the Fed could soft land the economy if necessary. And Karen, of course, addressed that. Now, the more one thinks that inflation is driven by outcomes and not forward-looking expectations, the costlier it becomes to stop inflation if momentum builds. And that was part of the argument drawn from the 70s about why you ought to have a preemptive policy. But if it's also you're coming from a very low inflation place, it also means you have more lead time to act before the momentum becomes very big. And so are the 1970s necessitating the Volcker disinflation a relevant example? I don't think so. I agree with our colleague Joseph Gagnon, who had a really insightful blog a month ago about the post-Korean War boom as a better analog for today. So as many have pointed out, if you look at the 1970s inflation, it had actually been building for a decade. You had structures of greater labor market power for workers, you had widespread indexation, you had a negative productivity shock, you had significant oil price shocks, you had dollar decline, you had fiscal politics breaking down, and a more reluctant Fed, and that builds for over 10 years before you get the inflation. So to me, I think if we end up in the scenario I'm talking about, and the Fed does end up deciding to raise rates, that's a mistake there, by the way, by not 2023 Q3, that should be 2023 Q1, and I'll correct that on the slide. I think a small hike, like 100 basis points over a few months, will be all you're going to need. And in that situation, it shouldn't be that hard to land. Now, there are some sources for worry, even if the Fed holds its nerve. As I've been arguing for some time, the way you get sustained inflation in a high-income democracy is less about your monetary regime and more about political breakdown. If you look at what's happened in Japan, along with the US, and a number of other less happy cases about debt sustainability, basically there are two factors. Do you have a credible threat that you can raise taxes through the legislative process if you need to? And is there no credible threat that households are going to start pulling money out of the economy into foreign currency? The latter, as I and Joe Gagnon and others have spoken about many occasions, does not seem likely. There may be some adjustment towards the euro. I doubt there will be any significant ongoing adjustment towards the renminbi. I'm not worried about that. But the political ability of Congress to sustainably raise taxes as needed is in doubt because of the divisions in our society and our political system. And to me, this is one of the reasons why the American Jobs Program, including meaningful pay-fors, is a useful thing, to show that you can actually raise taxes and you're willing to do that, and that it's spread over many years, but it is indeed a tax increase. I think that has benefits. Now, again, this may be, some people feel I'm bearing the lead. Financial fragility from raising rates may make a soft landing harder. I tend to be less worried about financial fragility than some people, given the state of non-corporate balance sheets, household balance sheets, given the improvements in bank supervision that I discussed with Randy Quarles on Tuesday. But I think we need to make the system more resilient and extend it to other aspects of the financial system beyond banking, as our colleague Anna Gelper argued in her memo for part of the Rebuilding the Global Economy. So to me, the inflation forecast is too low. It's going to be like 3%. It's mostly going to be driven by one-offs. The Fed is not going to be able to hold off as long as they should be able to hold off. So therefore, I expect them to raise rates in the first quarter of 2023. And, I hope I'm wrong on a lot of things, but there are things the Fed could be doing in the interim, particularly on the financial stability side, to make it more credible they can wait to raise rates. So why don't I end it there? And normally it's people other than me speaking, so I moderate, but now I'm sort of stuck moderating, and I'll toss a couple questions from the group to Karen. Reese Simons asks, Karen, what is your view on the proportions of excess savings that will be spent? Given the stock market performance, the investments in financial assets, is there a risk a high proportion of these excess savings are spent, and then some maybe negative wealth effects as there's a sell-off? Or do people keep hold of their excess savings in assets and then not get spent? So if you could unpack a bit more about that, please.
Yeah, sure. Thank you for that question, Reese. So I guess that you want to separate how many households are affected from what's going on with the number of dollars. So I do think that for households that were lucky enough to hold on to their jobs, 2020, they're going to come out of this pandemic in better financial shape than they were going into the pandemic. And so, and particularly for houses at the lower end that had almost no accumulated financial assets. Okay, but you want to kind of separate that from, numbers of dollars. So in terms of numbers of dollars, when you're thinking about excess saving, and especially when you're thinking about the excess saving that has gone into financial markets, that's probably concentrated at the top. So those folks probably, on average, have low marginal propensities to consume. To the extent that we see people consuming out of this, I think, I do think there will be some people taking money out of the stock market to consume, but I think it's going to happen kind of gradually over time. So when I talk, for example, about people who are retiring earlier because they are in better financial shape, I think don't think about them as taking all their money out of their 401ks over the coming year and spending it, but rather spreading it out over time. So low MPCs out of the excess saving.
Great. I'm going to keep going with some of the great questions for Karen. From Stephen Cicchetti. Karen, you noted that the U.S. fiscal response has been much larger than that in many other countries. Many Western European countries have much more generous social insurance programs than the U.S. Would we expect pandemic support that is as large in places like the Nordics or France? Can we think of the massive U.S. response as making up, at least in part, for the fact that our programs are rather stingy in normal times? If we make this sort of adjustment, would the U.S. fiscal package still look so much larger?
Yeah, thank you, Stephen. That's a really important issue. I had been, when I set out to create my presentation, I had been hoping to put up a nice chart that showed comparable fiscal support across countries. But when you dig into this, you realize it's a really hard exercise to try to do something that's apples and apples across countries, partly because the discretionary measures are kind of just differ greatly across countries. But on top of that, because you're flagging this important issue that fiscal support is not just these discretionary packages, it's our automatic stabilizers on top of that. And it is more generous in many European countries than it is in the United States. So yes, it closes the gap some. As best as I can tell from the sources I've been looking at, the US would still be ahead of other countries, even if you were looking at discretionary plus automatic stabilizers and looking at that across countries. So I have some numbers suggesting that kind of for Europe as a whole, the US might still be, the support might still be maybe twice as large as it is for Europe, but I haven't seen numbers specifically for the Scandinavian countries, for example. But thank you for flagging that.
Yes, thank you, Steve. Another question for Karen. I realize there's some nice questions for me being accumulated as well, but let me give one more to Karen. From Pamela Marr, what will be the relative impact of Biden's infrastructure spending package, assuming it gets passed, just announced in growth and the sustainability of growth versus a spending package that's made up of primarily direct consumer spending? I mean, in other words, is the infrastructure patch going to be better for growth and debt sustainability? Is it a good choice stimulus-wise? And obviously you can differ with the definitions Pamela's put there, but.
Yeah. So thanks, Pamela. I'll start by saying that my forecast did build in some expectation of infrastructure package. This package is not coming as a surprise to us, even if its details are. But there, I think, if passed, I would say, not really a 2021 issue. It takes time for this money to be spent. So in fact, they've said this is going to be kind of 8 years of infrastructure investment in the package. I think to the extent that you're thinking about it as stimulus, I think what it does, to the extent that it's kind of coming in 2022, it's actually constructive for supporting the recovery because it keeps you from falling off a cliff when all these other fiscal measures are expiring. So that's point number one about the stimulus value. I should also say infrastructure often involves putting people to work who are at the lower end of the skill/wage distribution. And to the extent that they are a source of concern in this recovery, I think kind of the infrastructure package could be constructive in that regard. just quickly on the longer term issue, yeah, infrastructure investment, if done right, is, it's very good for potential GDP, which is going to kind of help our productive capacity over the longer run. And with interest rates so low right now, basically this sort of investment is on sale. So I think, if done right, it can be kind of very good for the economy over the longer run.
Great. I'm going to take one question and then pose one question from the group to both of us. So from Carolyn Atkinson, she asks on market concerns, I'm focusing on her first question, what does it mean to say the Fed will not be able to withstand market pressures to raise rates? Is it political or financial fragility that will push the FOMC? I think, Carolyn, what I'm envisioning is some combination of, first, that the FOMC will insist, or at least members of the FOMC will insist on continuing to take seriously what's in the five-year forwards, what's in the TIPS market as genuine forecasts. As in a recent blog by Joe Gagnon from the Institute indicates, it's not a great track record of believing the bond market for every move in inflation over time. But I think just as a matter of ideology and inertia, a lot of people at the Fed will continue to say it. I think also politically there will be an issue. There will be people who will seize upon the idea that the Democrats are running up huge deficits. And this relates to a question Mazar Minovi has also posed, and we're going to get a couple Fed appointments, maybe a new chair, maybe not, in a year's time, or a little 9 months time, roughly. So I think there's going to be political pressure on the Fed from that end. Now, while they will not necessarily listen or cave to that, I do think it contributes to an environment where they will feel that their credibility has to be reestablished in some way. The late Marvin Goodfriend wrote about what he called inflation scares. And he wrote about that, I think, in the 80s. That when you get these interest rate spikes that are not necessarily justified by economic underlying factors or inflation trends, we haven't had to think about those for a very long time. And so that fact that this will stand out, I think, will be part of the issue for the Fed. Again, I hope they hold their fire, but I think they will ultimately feel they have to move. The financial stability aspects cuts both ways, because raising rates might worsen financial stability or might improve it depending on which side of the bed you woke up on. Karen, I'm going to gather a couple questions and take them to you. There's a bunch of questions about how this U.S. fiscal expansion and growth forecast affects the U.S. current account, the U.S. dollar, and the willingness of people to invest in U.S. treasuries. Why don't you tackle that bunch of issues, and then if we have time or I differ from you in any way, I'll chime in.
I think basically it strengthens our growth outlook here. So I think and coupling the kind of recent stimulus together with the infrastructure package, I'm kind of optimistic that it is going to, that the combination of all this stuff is going to kind of keep the dollar, well, I shouldn't say optimistic. I think it's going to keep the dollar strong. I do think, some of this demand is going to play out in terms of demand for imports, which is going to increase the size of the current account deficit, at least in the short run. As I said before, kind of we think it's going to be channeled through services. So, services are to some extent kind of concentrated in this country. We can go out and be tourists and consume services in other countries, but that's not going to happen until the virus is contained. So I think in terms of I think we will see some increase in some of this demand played out in terms of increased imports, but not all of it, because I think at least in this year, it's going to be focused in the services area.
So let me just add that I think the demand, there have been, as Carolyn noted, some wobbles in the treasury market. There is obviously in the scenario Karen is talking about, and the one I'm talking about even more so, some rise in inflation to go with the rise in nominal interest rates. But let's not forget the underlying reality, which is we're in a world where a lot of places are paying negative real interest rates on long-term government debt, and where China's party leaders are making the property rights security in the Chinese economy much scarier than it was even a few years ago. And that's a world in which the demand for safe assets and dollars goes up, in my view, and that have been insufficiently met. And so I'm reasonably confident that you'll still have relatively high real interest rates in the US compared to the other major options, and other things attractive, subject to a major political risk in the US, which God forbid we should have. We've reached our time. Thank you all for participating, for listening and engaging. Thanks especially to my colleague Karen Dynan, and to all our colleagues on the research side as well as on the communications and meeting side, who make the semi-annual Global Economic Prospects a success. This meeting is adjourned, and with it, the end of Macro March Madness Week at the Peterson Institute. Please tell your friends. Better than the NCAAs, at least this year. Thank you.
Thank you.